Hello everyone, welcome to Insights 21 into often heard less known things. So from today, we will deal with the topic options trading. We will cover all the basics and then discuss regarding some advanced topics regarding options trading. So starting with the session 1, the contents are as follows: derivatives, futures and options, forwards. We will learn all the basics as well as definitions with some real life examples, and strategies and basic terminologies in market. So what are derivatives? Derivatives are securities whose value is derived from an underlying asset or group of assets. The contract between two or more parties, and the price is derived from an underlying asset. So this is the basic definition of derivative. The examples are stocks, commodities, bonds, currencies, interest rates and market indexes. So taking an example of derivative, so what are derivatives basically is, taking milk as an example. So the derivatives of milk are milk products or dairy products, buttermilk, curd, etc. In the same way, the underlying asset here in this context is considered as milk, and the derivatives are buttermilk or curd, which are derivatives of milk. They are commonly purchased through brokerages. Derivatives are commonly purchased through brokerages. For example, Grow, Zerodha and Upstocks. So these are some of the brokerages. So more about derivatives. After 1970, they came into financial markets. More than 90% of turnover in daily markets are happening from derivatives. So derivatives came into financial markets after 1970, and the turnover of 90% on a daily basis are happening only from derivatives. National Stock Exchange or NSE is the largest Indian derivative market. So basically there are 5 types of derivatives: forwards, futures, options, swaps and swaptions. So we will deal with forwards, futures and options, but not regarding swaps and swaptions because it is not used in Indian market. So what are forwards as well as futures? So a forward contract is an agreement between two people where the price is predetermined and the actual contract happens in the future date. And this is basically not traded in the stock markets. In stock market, we can see only futures and options, but not forward contract. But for basics, we will also learn the definition of forward contract. Futures contract, same like forward contract, but the difference is the price is not decided now at a present date, but it is decided at a future date, or the price which is demanded in a future date. So the major difference between forward contract and future contract is only about price decision. The price decision is predetermined, or it is decided at the time of before the contract, or when the talk happens between the persons. But in futures, the contract as well as price determination takes place at a future date. First formal future exchange happened in Japan in 1697. So these are some important points in order to know about futures. Why was it started? With respect to futures contract, we'll study about the concept. Why was future contract started? It was started because of giving assurance about buying or selling at a future date. Example, agricultural sector, we can see farmers who produce only when some middlemen or buyers promise that they'll buy the product or the produce which they are producing. So only after the promise is given by the middlemen or buyers, the farmer starts producing the product. This is all about giving assurance about buying or selling at a future date. And buying or selling at a future date is not about deciding the prices according to the prices of market at present date, but the prices are determined on a future date, the rates of prices in a future date, that particular date. More about futures: no need to buy first, but we can sell and then buy later. This flexibility is only, or it can only be seen in futures and not any other market. And the difference between futures and cash market is very simple. In cash market, we can buy single shares, but in futures, we'll buy or sell the shares in lots. Futures will have expiry dates. In cash market, risks and rewards are low, but in future markets, risks as well as rewards are high. Especially when it comes to futures, buy is also called as long, and sell can also be called as short. So regarding margin money, we will be studying in session 2. So until then, make note of all the topics we have studied until now, and once you are thorough with all these topics, you can start watching session 2, options trading. Thank you.